So we're going to be talking about income today, and income comes from a lot of different sources. For a lot of our clients, of course, Social Security is one, right?
Social Security, RMDs, required minimum distributions.
Inherited IRAs.
Yep, those also have RMDs, regular distributions from regular accounts.
Yeah, like dividends,
yep.
Such as that.
Social Security. Yeah. So there's a number of income streams that people enjoy in retirement, even pensions. Some people have those. So we want to talk about today is all the different types of income streams that people deal with, and some of these you can control, like a Roth IRA or just your regular account. You have control over that. Others you don't. When you have inherited IRAs or where you have Social Security,
required minimum distributions, a lot of times that just comes out to you.
That money's coming to you. So we want to talk through what you can do and what you need to be aware of.
Yeah. You're listening to Randy Barkley and Jeremiah Lee. I'm a certified financial planner. Jeremiah is also a certified financial planner, but he's also an attorney. And he helps our clients with legal issues such as estate planning, in some cases, business succession planning, and things like that. But today we're going to be talking about income. And the top of the subject matter is Social Security, because that is the number one income source for people as they head into retirement.
Yep.
Now, it's never designed as the primary source of income. It was never set up that way, but unfortunately, some people use it as their primary source. But anyway,
Yeah, one of the things we'll talk about today is, I guess maybe we'll start with, is there's a lot of people who are concerned about Social Security. They say it's this giant obligation the government has, and they're not taking enough money in. So they look at the baby boomer generation, and they're looking at how many people are taking Social Security or will be in the next decade or two,
right?
And how many people are paying into it, and there's concerns. And the last numbers I saw was that Social Security, the whole system, runs out of money in 12 years.
Right.
In 12 years, they run out. And this is
that's good for me, but I mean, it's terrible for you.
Terrible for me. And one of the Social Security had a big year last year. Most people don't know this, but Social Security for the first time paid out more than it took in. Mm-hmm. And that's what we're heading into, is that Social Security has these obligations and it keeps paying out, but it is not going to have the ability to take in. And so the concern is, 12 years, we run out of money. And there's a study they did, and it said 50% of millennials, so kind of my generation, 50% don't believe Social Security is going to be a meaningful thing when they retire. And then it was 30% for Gen Xers and only 15% of baby boomers that said we're not going to get anything.
Yeah, I wonder, I'm always curious about how these rumors get and how people get a hold of it, and they become, so to speak, truth in their mind as to what's going to happen. But I think more from a practical standpoint, you need to understand how Social Security works for you and how you can claim different options of how you receive it, particularly if you're married, whether your spouse is an earning spouse or a non-earning spouse. And there's all these different options and such as that. And, I'm coming off this article that we use this one particular author. She's probably the best when it comes to Social Security. But she advises that people go to the site. Because of COVID, they're lacking in the amount of good advice to people that go to their offices right now.
And there's a lot more that's available online.
Right.
It used to be you could do maybe one or two things online, whereas because of COVID, the Social Security office, they've put a lot online. And the hard part, and the part of this article was an interesting story of a woman who called in, was told what she could do or what she couldn't do, and that was inaccurate. And I imagine for the vast majority, when you call a Social Security office, you're going to get accurate, appropriate advice. Or I guess not advice, but probably direction of what you can do, your options. However, some of those are still in training. And so it was a really good comment to say, go on the website, see what your options are and get professional advice. I mean, that was kind of the takeaways I had, is that you either talk to a professional or go to the website, knowing that because of COVID and because of training, you might not get fully accurate information. Yeah,
and if you need more information about this, we'd be more than happy to give it to you. But basically, it's www.ssa.gov, right? I believe. Mm-hmm. And then there's an 800 number. But what I found that they are, I'm claiming Social Security. And I find that the website is very helpful. It helps me to understand. Actually, it's better than, in my opinion, than going into the office and talking to somebody face to face. I find like I get
good details,
get a better outcome.
So some of the items that people, I guess that will be the comment that people have about Social Security is it's going to go away. It's going to go to zero, which is not, I think, a realistic concern. It is going to be different. My generation is going to have different Social Security, but the differences are not going to be, in my opinion, and others as well, so stark as to say it's going to be zero. So I think it's 1983 is when they were having issues with Social Security, and so they bumped the retirement age when you could have that full retirement from 65 to 67, and that's just now taking effect.
Yeah, and they also increased the contribution amounts. I mean, the salary base, they increased the amount that people have to pay, and then, of course, under the current you know what a lot of the legislators are talking about increasing that and making it, they don't cap it out, so you continue to pay on Social Security no matter what your income is.
Yeah, and people who may not know, if you pay Social Security on the first $147,000 you make, so someone who makes $80,000 is going to pay Social Security on all their earnings, where someone that makes $200,000, the Social Security contributions stop at $147,000, and everything else they don't have to keep paying into Social Security. And there's people who want to take out that cap to say, why are we making this windfall for others? Others say, no, it's fair because you're putting in your fair share. And so anything excess of that shouldn't be included in Social Security.
I mean, again, Social Security is a social program, and it's designed to be distributed amongst all the people. And, you know, people can kind of complain about how it's managed and such as that. But it is a program that most people have become dependent and expect that they're going to get that going forward in their life, right?
Yeah, and based on the numbers that we see for Social Security, there needs to be some adjustment, whether they increase the age, whether they change the cap. There has to be some adjustment. So people who are 10 years or so from retirement or in retirement, no effect on you.
Right.
This is going to run out your whole lifetime. It's going to be a normal program. People who are, I don't know, 45 or so now, maybe, and people who are under that, they're going to have a different system. And whether that just means they pay in more during their life, or they have to start taking their distributions a little later, that may be. But one thing that I like to stress with clients is that Social Security, I'd say for a lot of our clients specifically, shouldn't be the main driver of your retirement. It's a piece. It's absolutely a piece. But as much as possible to control the things you can control during your lifetime, to make it so Social Security is extra, it's peripheral, and not something you're depending on. There are people who absolutely depend on Social Security, and they will continue to.
Yeah,
but ideally, if you have a runway and time to work with pensions, to work with your 401k, to work with other assets and income streams, to make Social Security an extra item and not something you're depending on.
Right. I think let's kind of jump over into another key aspect that we deal with, and that's required minimum distributions. And we could delve into inherited IRAs, but let's just stay with required minimum distributions right now. If you have an IRA account, a qualified account, by and large, you have to take out a required minimum distribution when you turn age 72.
72, it moved. It used to be 70, and a lot of people remember that, but it's now moved to 72.
Yeah, so at 72, you have to take out a certain percentage, and the amount that you take out is based upon the value of your retirement accounts on December 31st of the previous year.
Which is a key point, and this doesn't come up a whole lot for a lot of our clients, but I've heard people ask this question to say the market's gone down.
Right.
Does my required minimum distribution go down?
Right.
Or the market's gone up. Do I have to take out more? And the answer is no, it doesn't shift. It all depends on the balance of your accounts on December 31st the year before. So what may have an impact is if we have a down year, that next year, December 31st, maybe your values are lower. So that won't impact the following year. But whatever happens throughout the year, up and down, does not impact the dollar value of the RMD you have to take.
And the percentage you have to take out is still relatively modest. I mean, when you first start out at age 72, it's less than 4%. It's 3.65% or something like that. It's relatively small percentage. Yeah. So even if your account value went down, it's not probably going to change your income amount that you're going to receive.
Yeah.
And you can choose to receive it on a monthly basis, or like some people, they wait until the end of the year. But you have to take it out before December 31st of that year.
And the reason for RMD's required minimum distributions, most people I think understand this generally, is that when you put the money into this plan, it was tax preferred. You didn't pay taxes on it, and it's been sitting and growing your whole career without paying taxes on it. And the government said, in order to participate in these programs, we'll allow this tax-free growth, but we want you to take it out meaningfully in your lifetime. So at age 72 now, you have to start taking it out, and you take out every single year, year over year. And for a lot of our clients, as we look through this, and anyone who's listening, you need to kind of look at how much that's going to be. We've had some people who have, in essence, oversaved for retirement, and they get inundated with RMDs as they get later in life. And it's not so much they have too much for retirement in general, it's that they have too much for retirement in a qualified plan that's going to make them take it out.
Correct.
Having too much money is not a big problem, right? It's something that most people would like to have, but we've had a number of clients who get into their 70s, they get in their 80s, they get 85, and they're pulling in significant income every single year, and they don't need it.
I mean, the more money, they're taking in more money than what they made when they were working full time.
That's right.
And it's all subject to income tax. There's no deferral. So we're going to take a break right now. We're going to come back and we're going to continue our conversation about income. I think I want to transition to inherited IRAs, because there's been a lot of changes to that, and there's a lot of misunderstanding on that.
Yeah.
So stay tuned. We'll be right back.